The Property Pod. Welcome to The Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hi there, and welcome to The Property Pod, South Africa's premier property investor podcast. Happy New Year, and here's to 2025 being a great year for the SA economy, including the property sector, of course, which needs strong GDP to really grow. My name is Suren Naidu, and on this weekly Moneyweb show, we gain insider insights from leading executives, analysts, developers, and entrepreneurs in South Africa's vibrant property industry. Last week, we had the finance coach on the podcast sharing his insight on the property sector performance on the JSE and expectations for 2025. We continue with this topic on this week's show, but we have the fund manager of one of South Africa's biggest property institutional investors on the podcast. He is Nesi Chetty, fund manager and head of Stanlib. Welcome to the Property Pod, Nesi. It's our first one for 2025.
Hi, Suren. Happy New Year and best wishes to your readers and listeners on Moneyweb for the year ahead.
Nesi, before we get into the performance of the sector and expectations for the new year, I think a big thing this year is the JSE's new benchmark proposals for the property sector. I know Dipula, for instance, was quite excited last year when they talked about the potential of being included in one of the property indexes. What's your view on this move by the JSE to include more shares in these indexes? Is it a good thing?
Yeah, thanks, Suren. Look, I certainly think it's a positive thing. If you look at the OLP, which is the J803, it's one of the widely used property benchmarks in the sector. If I look at it currently, what the JSE is trying to do is effectively widen the scope of the OLP by using not just the all share index REIT counters, but also the property companies that sit within the fledgling index. If we look at the total list of companies across the two, it probably sits at about 41. What the JSE is effectively canvassing from shareholders is if they use their liquidity and I guess their free float criteria, effectively, there's 21 shares that would meet those criteria and would be included in the OLP. That would mean 4 new shares that would be included, Suren, being Dipula, Octodec, Spear, and Schroders. These are companies, I guess, if I look at institutional and retail funds, investors have either held them as out of benchmark bets. And certainly they're very different companies in terms of their subsector and retail mix. I think it's very positive. The OLP, I guess the criticism of the old SAPI is the big concentration risk. If you look at the SAPI, it used to have more than a quarter of the exposure sitting in NEPI at 27%. The OLP with this inclusion doesn't necessarily remove some of the large concentration risk. If I add up the top 5, you probably get to about 57%. But I guess there's more convergence in the sector. These companies do add a little bit of, I guess, different retail and offshore mix as well. And certainly, if I look at the weightings between the 3 or 4, Dipula would come in at about 1.5%, and Octodec and Spear close to about 65 basis points each.
It's interesting. So what does that mean for property investors, both retail investors and institutional? Do they focus more on the LP now rather than the SAPI?
Suren, I think what you'd find is that the JSE, within the last couple of days, they've released a notice saying that they will continue to maintain the SAPI, the J253 and the J254. So they're not going to terminate it as yet. So they want to give investors maybe a little bit more time to sort of analyze their portfolios and see what type of rebalance they would need to do. But also canvas their clients in terms of moving some of their clients over from the old SAPI into new OLP mandates. If that did happen, it would mean some element of rebalancing for passive funds. There are some, I guess, passive or index funds that manage to SAPI, and where NEPI is quite large, and some of the other big names, they would potentially need to sell some of those counters. I think the OLP for me is probably one of the preferred benchmarks because it satisfies, I guess, the criteria of liquidity, It's representative, I guess, of the risk and return characteristics. Although we call it the OLP, I mean, there's still a fair share of the earnings that come through from inward listed companies as well.
Thanks for that, Nesi. I know I'm mixing up my questions here a bit, but this is almost the latest developments in the sector, which a lot of the funds will be very interested in. As I mentioned, Lipula were very excited about that. But it's interesting you mentioned Spear as well. That's a purely Western Cape-focused fund, and they're doing pretty well, but they're quite small. You are a bigwig in property investments at Stanlib. What are your top SA REIT property stock picks for 2025?
Yeah, so if I look at the South African property market, I mean, we effectively invest in companies according to our process and philosophy, where we look at companies we think over time will provide us sustainable income and capital growth over a 3 to 5 year period. And essentially, as a fund management business, we want to invest in those REITs that can satisfy a couple of criteria: generate good quality earnings, have very good assets that we think through the cycle will be defensive, but also have very good management teams that can extract value from the underlying funds. And I guess if I look at property, I mean, it's basically management teams buying assets, selling assets, but also trying to navigate a very tough leasing market. If we look at our bottom-up process in terms of valuation, I mean, the shares we still like within our universe. I mean, Vukile is one where I think if we look at the business mix, it has two distinct operating segments which are growing quite nicely. We like the fact that it has lower LSM retail. It's a significant scalable business. It's at 16 billion on the SA retail side, and they generate about 1.3 billion of net operating income. So the yields there are around 8.6, 8.7, but it's a collection of hand-picked properties. We like the fact that if I look at the Vukile lower LSM retail portfolio across the commuter, CBD and township, they're all growing trading densities at very nice 3 to 4% levels. Vacancies are low. The township side, I mean, it's about 1.5, and then the commuter about 2.6 as well. If I look at Vukile, I mean, they're one of the few businesses in the South African market that's been able to come and raise equity capital quite successfully. They did this last year. They raised about 1.5 billion to reinvest, I guess, into the Portuguese and Spanish market. They were fortunate that, I mean, given the attractiveness of the assets they had bought, I mean, they did get an offer for their last stake. We like the fact that over time, there's very little heavy lifting to do in terms of refinancing. Certainly with Castellana, their offshore business, I mean, there's no debt maturities that they need to sort of fulfill till FY26. LTV has come down, so it's sitting at about 41%, and this is from pre-COVID levels. But valuations for us are very attractive. We think we can buy this business on a very attractive forward yield, 7-8% divi yield, and also trading at a significant discount to NAV. So that would be one, I guess, in the that has both local and offshore exposure that we like. The other one that we potentially like as well, and I think you mentioned it, would be Spear. A very different company in that it's got dominant Western Cape exposure. Leasing fundamentals across the Western Cape have been strong. It's a buoyant job market as well. Spear have done well, Suren, to grow their asset base. Their portfolio is now sitting at about 4.6 billion. And what we like about this business is, I mean, they've stuck to their knitting and also the simplicity of what they're trying to achieve. They're trying to grow in the right areas, being retail and industrial. They bought a sizable portfolio from Emira of 1.2 billion, which is giving them a little bit of scale. The NOI yield on that transaction after fees is about 9.5%. Although the operating environment remains challenging, we think this is a business where if we look at forward yields and certainly the type of brownfield redevelopments they're going to do, will make it particularly attractive to an acquirer that wants to gain Western Cape exposure probably 3 to 5 years out.
Can I interject, Nesi? What are you saying? Are you saying the same thing that Finance Coast told me last week?
So then,
are they a buyer target?
Not necessarily. I think if I look at Spear, I think there's a few strategic objectives that the next couple of years that they would need to satisfy. But if you're a big fund looking for Western Cape exposure, there's not many listed REITs that you can necessarily go and buy. That's one, sizable, and one and secondly has a collection of very good assets with low vacancies as well. I mean, if I look at the occupancy rates, Spear sitting at 95%. I don't think necessarily this is a takeout target maybe within the next 12 months, but I think if it continues to demonstrate strong distribution growth and a re-rating in the share price, it makes it an attractive portfolio. And if one looks at the size, it's quite scalable as well, and it's getting into the OLP next year. It's one we've liked, and I think the discounted NAV is very appealing. But Suren, I mean, there's quite a few shares within the OLP that are trading at significant discounts to NAV, not just Spear. The other one I think I would add in terms of inward listed exposure, one that's been very stable is Nepi. Nepi we've liked. It did 20% last year. But I mean, it's a high quality portfolio of retail assets spread across Eastern Europe. It's a 7 billion portfolio. They're growing their NOI in high single digits, and the occupancies are high as well, 97%. They've done quite well, I guess, to come to the equity market and raise about 300 million euros, which they placed at a 4% discount to the underlying at the time. But they've used most of that to recycle into their acquisition pipeline. You would have seen they would have bought a property now in Katowice. That's a very good asset, dominant in that space, 88,000 square meters. We like the fact that you can buy in Nepi where it's still growing. You're getting exciting yields in euros of 7 and 8%. And last year was a period where the rand strengthened for the first couple of quarters. You only saw that rand weakening in that last quarter. And I think this would be another period where 2025, you see a rand weakening. Nepi is not a bad place to be positioned where you benefit from some of that re-rating.
Thanks for that, Nesi. I asked that question around stock picks because it's forward-looking, but let's look back a little bit now. Performance-wise, regarding the listed property sector, it was the top-performing asset again in 2024. Expected, one would say. What are your thoughts? Which were the best and worst-performing stocks?
Yeah, so if we look at it at a total level, I mean, the property market did some 30% for the 1 year period to end of December. And so then if I look at the South African market, most risk assets did well. So equities did, if you look at the all share that came in at about 13.5%. Bonds, which at times have been very closely correlated to property, did about 17% last year. So you would have seen that the rate-sensitive shares in the South African market all had a phenomenal year. And if I clumped them together, these would be the banks, the retailers, and the property companies as well. And those returns that I quote are total returns, so they do include the dividends as well. So 3 points there, Suren. I mean, the properties come off an exceptionally low base coming out of COVID. And you'll remember, I mean, they had rental recession, they had rental concessions. A lot of the power sat with the tenant at the time. Coming out of COVID the last couple of years, there's been a shift in momentum where I guess the landlord is getting back some of that power in terms of pricing. Certainly the market, and if I look at the big macro fundamentals the micro fundamentals that we track within the sector are starting to turn positive. I mean, the retail reversion environment has certainly moved from negative to flat. So it's certainly slightly up in certain instances. If we look at the top line, in some instances in retail, I mean, you're getting foot count up in the last 2 quarters of the year. Food continues to perform as a strong category. I mean, there are signs that maybe a pick and pay could turn around, but you're seeing more and more across the retail funds, stabilization of portfolios. And certainly in offices, there's less noises about big negative reversions in the sector. So the last 3 years has been effectively a period of rebuilding balance sheets, bringing down LTV, and across most of the companies that's happened, and also simplification of offshore businesses funding especially when it comes to things like cross-currency swaps. But so then that's the past. I guess if one looks at forward-looking indicators, one must remember that the volatility of property sits in between stocks and bonds. We're not calling for another year of 30%. I think returns will be moderated, given that yields are sitting anywhere between 8 and 9%. And with capital growth of 3 or 4 on top of that, you're likely to have a period where you get sort of on a sustained basis 12, 13% compounded returns from property. But Suren, there were big differences between the best and the worst performing shares in the sector.
So looking forward to 2025, you hinted on that a little bit. Maybe not the growth we saw last year, but will it still be in the double digit? And what about, these huge stocks, the likes of Growthpoint and Redefine? Will they clearly take longer from a divvy perspective, growth-wise, because they are diversified, but they have quite a big office component, and despite the reduction in rent reversions, there's still some time to go for them also to benefit, particularly from interest rates. They're not purely retail-focused funds.
Yeah. And so then I guess that's an important point. I mean, if you look at 2024 and you look at the best performing shares, I mean, Attack was up some 60%, Hyprop was up at a similar level, Fairvest was up about 50%. So there's a clear theme. Last year was a year where retail property did very well. And what underperformed were your UK listed shares. So the likes of your primary healthcare properties, which is down 14, and the retail UK funds like Hammerson and Shaftesbury. I mean, the UK has been in a tough space. I mean, inflation crept up, and they weren't early in the rate cutting cycle as well. The OP, while it did 30%, I mean, Growthpoint did underperform it for the full year, delivering a return of 20%. Now, Growthpoint, I mean, at the start of 2024, when they put out their guidance, they did guide, I guess, to earnings or distribution growth going backwards. And effectively, I mean, it was negative. It was the worst of the large companies. If one looks at the Growthpoint portfolio, effectively, it was the waterfront that had done very well over the 12-month period, but other parts of the offshore business had come under pressure. And so then if you look at the Growthpoint Australia, I mean, it was one of the years where it actually had a write-down in the underlying assets as well. There's a lot of work to be done at Growthpoint in terms of simplification of their offshore businesses, but there's also a lot of opportunity as well. So then, I mean, if you look at the ability to extract underlying value from the waterfront, I mean, they've applied for 315,000 square meters of planning improvement for additional bulk rights there, and that could be potentially a 15-year project where they look to do more development, but it's going to cost some 20 to 24 billion. That's the sort of base case for the full development. So I guess this could be a year where you see some of those plans, I think, being articulated more firmly in the market. But the distribution, I mean, you're not going to get high single-digit distribution from Growthpoint this year. And I think if I look at the operating metrics, certainly outside of the waterfront, there aren't many assets that sit within the retail portfolio in Growthpoint that are, let's call it, under-rented. Maybe worthwhile just to mention, I guess the best performer, Hyprop, I mean, that was a function effectively of, I mean, them being able to implement the high state liquidity event. They did bring down the LTV over the period. And what was quite significant is they made that acquisition of the Table Bay in the Western Cape for 1.6 billion. So distribution growth, I mean, they definitely surprised on the upside. They were able to do the drip in previous periods, but the big re-rating came through because distribution was a lot more positive than the market expected.
Do you want to share some insights on Redefine, though?
Yeah, so if one looks at Redefine, certainly the retail portfolio has held up over the 12-month period. Redefine has done quite a bit of work, I guess, in terms of bringing EPP into the broader group. There's still, I guess, maybe if one looks at Redefine versus a Growthpoint, maybe if the office portfolio is and particularly the tail of the office portfolio looks a little bit better than Growth Point. I think if I look at it at the 12-month on a 12-month basis, certainly the distribution growth coming out of Redefine would be a lot more stronger than Growth Point. And Redefine doesn't have the complexity of having now businesses that are sitting in Australia. The only business that it needs to sort of look at in terms of extracting efficiencies and maybe cost savings now is EPP.
Thanks for that, Nesi. I know you talked a little bit about capital raising, but you mentioned Vukile, particularly in terms of how much activity on the capital raising side. What are your thoughts on the sector-wise? Will we see an increase in capital raising activity in 2025, considering the sector is still trading at a discount, but things have improved?
Yeah, so Suren, I think the capital momentum certainly had picked up in 2024. One must remember that if you go back a decade, between that 2013 to 2017 period, there's almost 40 or 50 billion per year being raised in the South African market, property market. I mean, it peaked in 2014 at 69 billion. Just after Resilient Gate, the capital raising dropped from 49 billion in 2017 all the way down to 14 billion. So there's been a steady recovery in the market. But there's only a few companies that have been able to come to market to successfully raise capital. And those companies have seen their share prices trend back to NAV. They're not trading at premiums to NAV, but they've been able to raise, I guess, equity on the market at a significant 4-5% discount to the underlying. If I look at 2024, I mean, the number it'll probably settle at is about 14 billion plus in equity that's been raised. There were 3 companies that were able to come to market, Vukile being one of them. They did 1.5 billion in September last year. They placed shares at about 17 Rand, so that would have been a 4% discount. The shares are trading now closer to 18 Rand. So they're able to fund some of their acquisition pipeline, pay down a little bit debt, but it was very much opportunistic as well, Suren. I mean, the sale of LA now means there'll be proceeds coming in, which they'll look to recycle into Portugal. Nepi did a very good placement, 300 million euros in about the middle of the year. They then went on, I guess, to announce that they're buying the CLSS city center in Katowice. It's an area they've understood. They operate there before. That's a 405 million acquisition. And then the last one would have been Spear. Spear did a vendor placement of about 460 million, a price of around 9 Rand 10 cents a share, but that was effectively to recycle that into the Mira acquisition that they did, Surya.
Just on the corporate action side, do you expect to see more of this in 2025? Perhaps a little bit of consolidation in the sector, or rather private deals where they might look at opportunities to expand with buying from private developers and that sort of thing?
Yeah, so Suren, I guess the dynamic you have in the South African market is there are funds that are looking to acquire, to increase in size, and there's also funds looking at complementary assets within the sector. If one looks at the last 3 years, I mean, the 2 big deals we had was, Standard Bank buying out the minorities in L2D, and we had Multilet that was bought out within the sector as well by one of the big funds. If we look at deal making, I mean, we don't necessarily want to see deals where companies are overpaying. That potentially leads to dilution. The winners there, Suren, are the investment banks or the advisors that just earn huge fees. Shareholders suffer the most from those type of transactions. I think mergers and acquisitions make sense in terms of where complementary assets are being acquired and where the management teams can potentially work together. Taking a high LTV company to go and buy or acquire a low LTV company to fix high levels of gearing doesn't necessarily change the market perceptions on what the acquirer is going to be valued at. I think there's a temptation now in the market for some companies to use their highly rated paper to maybe overpay to achieve significant scale. And you see, I guess the lesson to be learned there, if you look at the acquisitions that have happened, I mean, the smaller companies like SA Corporate acquiring AFCO and Fairvest acquiring Arrowhead, those type of acquisitions take time to digest and absorb and integrate those businesses into the underlying. So it takes time. And sometimes there's dilution in year one, but you need the shareholder support on both sides. You're also going to see, I guess some companies with maybe complicated historical capital structures like Fortress are now for the first time, I mean, they can potentially look at acquisitions in the market. I mean, they can fund themselves internally and also look to raise capital if there are opportunities that are very accretive yields. But what we want to see, I guess, is institutional fund managers and shareholders in the sector is more discipline when it comes to deals.
Well, Fortress, I don't want necessarily more comment on it, but they're not a REIT at the moment and they're not paying dividends, so they've got some money to spend in terms of growth. Just to conclude, Nesi, what about the risks and tailwinds for the sector? It's not just about negatives. There is the interest rates falling. It might not be as big as we would like, but also the GNU, that there was a lot of hype around that, but that's also another thing that will benefit the sector, but perhaps over the long term. Do you want to share some insight on those risks and tailwinds? And you also have external macro factors like Trump and uncertainty from that perspective globally.
Yeah, so I think the GNU impacts, by and large, you've had a big leg of the re-rating in the market that's happened in property on the back of that. So we were very constructive on the SA Inc. recovery post the GNU because we saw a situation where, I mean, the consumer was still looking okay, although defaults were down. You had trading densities in certain instances were benefiting from consumers accessing the two-pot. 2024 saw, I guess, the start of interest rate cuts and more to follow. On the positive side, we're probably 300 plus days of no load shedding in SA. So property companies are not necessarily accumulating huge diesel costs. In certain nodes like the Western Cape, so then employment is up. So that's all positive. But the new government and I guess the GNU is making people a lot more positive despite the challenges. So confidence is certainly up. However, we would caution a lot of these have come through improved valuations. And if we look at it in 2025, what will we need to see for further re-rating? We need to see execution on key infrastructure projects, potentially ports, the railroad, to support our base case valuations. SA removal from grey listing is key. I mean, National Treasury is estimating that to be in June 2025. One also needs to watch carefully what's government's stance and whether it's still under pressure to revive, I guess, NHS ambitions and maintain social security benefits, because these are all things that I guess their commitment to staying away from will keep the property market quite buoyant. I think the big macro or catalyst for the macro drivers were very clear maybe at the start of last year. It's not as clear as 2025. I think if I look at on the global front, I mean, Trump's going to be sworn in as president on the 20th of Jan, and we're going to have the usual threats, the tweets, the usual noises on what policy he wants to implement. But unless we hear the announcement and the clarity on that, it's difficult to put into a model. I think rate cuts will continue this year. The SARB won't necessarily cut unless maybe there's a clear indication that inflation is coming down or the US is on a firm rate cutting cycle as well. What will definitely buoy our market, so then as we get this earnings recovery coming through, is certainly, I guess, the deal making and corporate action. And don't forget, I mean, these property companies can't get too cheap, because if you get to very attractive yield levels, given that they're not paying out all of their earnings as distribution, they can certainly do share buybacks as well. And lastly, maybe what's encouraging, I guess, if one looks at property weighting across balanced funds, it's certainly been steady the last couple of quarters, and just a sign that I guess general equity investors are acknowledging now on this three-year period, property returns have outperformed both bonds and equities, and we're getting to a period of stabilization in listed property returns.
Thanks for that. It's a good note to end on, Nesi, because the interest rate will be a factor. But there are positives. I had a tongue-in-cheek intro in my story on Growth Point's development in Sandton, which is Resi. But clearly they want to push the button on that on the back of lower interest rates and potentially some positives around the GNU. But we'll have to leave it there, Nesi. It was a long interview, but very insightful. I appreciate your time on the podcast.
Thanks, Suren.
That was Nesi Chetty, Fund Manager and Head of Property at Stanlib.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories. The Property Pod.
Moneyweb, your trusted source for business and investment insights.